Right now, as I speak to you, Supermicro Computer Inc., ticker symbol SMCI, is trading live at approximately $33.36, hovering with a tentative gain of roughly 1.6% in today's early intraday session. The market is open, the numbers are flashing, and if you look at the chart, you see a stock that is trying to find a pulse after a brutal, relentless slide that has wiped out over 35% of its value in November alone. It is battling to hold the $33 line, a psychological trench that separates a potential recovery from a free fall into the 20s. But stop looking at the green tick on your screen for a second. That 1% intraday green candle is a distraction. The expectation most retail investors have right now is that SMCI is simply a cheap Nvidia proxy, that because they make the servers for the AI boom, this dip is just a temporary glitch, a buy-the-dip moment gifted by the gods of volatility. They see the PE ratio compressing and think value. Here is the reality. Supermicro is no longer just fighting for growth, it is fighting a war on two fronts that most people aren't even watching. While you are worried about the daily price action, the company is bleeding out on margins in a way that suggests their moat was never as deep as we thought it was. The reality isn't that this is a discount. The reality is that the entire thesis of the company is shifting from AI innovator to commodity box mover, and the market is punishing them for it. The drop isn't a mistake, it's a repricing of their soul. So grab your coffee. We need to have a serious adult conversation about what is actually happening inside the data centers and boardrooms of Supermicro Computer Inc., because the mainstream headlines about accounting are 6 months out of date. The ghost of 2024 versus the silent killer of 2025. Let's clear the air immediately. If you are still obsessing over the delisting headlines from late 2024, you are fighting the last war. Yes, in late 2024, the company terrified the street by delaying their 10K filing. Yes, it looked like a repeat of their 2018 delisting nightmare. But that situation was largely resolved in February 2025 when they finally filed, paid their penance, and regained compliance. That drama is the old reason to be scared. The new reason, the one that should actually keep you up at night, is far more boring and far more dangerous. Margin compression. In the first quarter of fiscal 2026, which ended recently in September 2025, Supermicro reported gross margins that shocked the street, dropping to roughly 9.3%. To put that in perspective, a healthy hardware company in this space usually targets the mid-teens. When your margins drop into the single digits, you are dangerously close to becoming a charity for your customers. Why is this happening? This is the expectation versus reality crunch. The expectation: SMCI has a first-to-market advantage. They get the Nvidia chips first, they build the liquid-cooled racks first, and they charge a premium because desperate data centers need them now. The reality is that that advantage has eroded. Dell and HPE, Hewlett-Packard Enterprise, have woken up. They are massive. They have supply chains that dwarf SMCI's, and they are willing to price aggressively to steal market share. Dell isn't just knocking on the door, they are kicking it down with comparable liquid cooling tech and better enterprise support. SMCI is being forced to slash prices to keep their seat at the table, and that is shredding their profitability. The reality isn't that this is a discount. The reality is that the entire thesis of the company is shifting from AI innovator to commodity box mover, and the market is punishing them for it. The liquid gold gamble. To understand if this stock is dead or just sleeping, you have to understand the technology they're betting the farm on: direct liquid cooling, or DLC. Traditional data centers use giant air conditioners to blow cold air over hot servers. It's inefficient, loud, and expensive. But the new AI chips, specifically Nvidia's Blackwell series, run so hot that air cooling is physically impossible. You must use liquid. You have to pump coolant directly to the chip to whisk the heat away. Supermicro's entire bullish thesis rests on the belief that they are the kings of liquid cooling. They claim they can ship these complex, plumbing-heavy racks faster than anyone else. And for a while they could, but here's the nuance the bulls miss. Liquid cooling is hard to scale. It involves hoses, manifolds, coolant distribution units, and the terrifying risk of leaks. A water leak in $1 million server rack is a catastrophe. Reports from the supply chain in late 2025 suggest that while Supermicro is shipping these units, the complexity is slowing them down, and the costs of manufacturing these bespoke systems are higher than anticipated. This is why their revenue guidance is huge, $10 to $11 billion for the next quarter, but their profit guidance is thin. They are shipping the revenue, but they aren't keeping the cash. They are effectively passing Nvidia's wealth through their bank account without taking a big enough cut. The institutional tug of war. Now, let's look at who is actually holding the bag. If you look at the 13F filings from late 2025, you see a fascinating divergence. This isn't a mass exodus, it's a rotation. On one hand, you have retail investors panic selling because the stock chart looks like a ski slope. On the other hand, you have sharks like Goldman Sachs. In their filings from the third quarter of 2025, they actually increased their position significantly. Why? Because they are playing the volatility. They know that SMCI is one of the few stocks with a beta high enough to double in a month if good news hits. Institutions are treating SMCI not as a long-term compounder like Microsoft, but as a leveraged call option on AI buildouts. They are betting that the Blackwell Ultra orders, which SMCI claims total over $13 billion, will eventually turn into realized revenue that forces a short squeeze. Comment below how many shares of Supermicro Computer you currently hold. Are you averaging down at these $33 levels, or are you waiting for the dust to settle? I want to see where the sentiment is in this room. The Dell factor, the elephant in the server room. We cannot analyze SMCI without talking about Dell Technologies. If SMCI is the scrappy, fast speedboat, Dell is the aircraft carrier. In November 2025, while SMCI shares were tumbling 36%, Dell stock held up far better. Why? Because corporate CIOs, the people writing the $50 million checks for server farms, trust Dell. When you buy a server from Dell, you get a service contract, a human being to call when it breaks, and a supply chain that doesn't blink. When you buy from SMCI, you get the hardware fast, but the support infrastructure is historically thinner. As AI moves from experimental training clusters, where speed matters most, to production inference, where reliability matters most, the market is shifting towards Dell. This is the structural risk that no amount of technical analysis can fix. If the customer base shifts from move fast and break things to reliability at scale, SMCI loses its core edge. Financial health, the balance sheet deep dive. Let's look at the numbers that don't make the headlines. The company's cash position is decent, sitting around $2.1 billion in cash and equivalents as of the last report. But their debt has ballooned to support this inventory build. They have to buy the Nvidia chips before they can sell the servers, which burns massive amounts of working capital. This is a cash flow negative business model in the short term. They burn cash to build inventory, hope to ship it fast, and get paid later. If there is any hiccup in the supply chain, if Nvidia delays a shipment, or if a customer delays an installation, SMCI is left holding the bag with expensive inventory sitting in a warehouse losing value. This inventory risk is what is suppressing the stock price. The market is terrified that they are holding billions in chips that might become obsolete or harder to sell if the AI hype cools even by 10%. Future outlook, the 2026 scenario. So, where do we go from here? What is the outlook for 2026? We are looking at a binary outcome. There is almost no middle ground for the stock. Scenario A. The comeback kid. In this scenario, the margin compression we are seeing now is proven to be temporary. SMCI optimizes its manufacturing for liquid cooling. The costs come down, and they successfully deliver that massive $13 billion backlog of Blackwell servers. If they can get gross margins back up to 12 to 13% by mid-2026, this stock is fundamentally mispriced at $33. The earnings power would effectively double, and you could see a rapid repricing back towards the $50 to $60 range. This is the Goldman Sachs bet. Scenario B, the value trap. In this scenario, the competition from Dell and HPE proves permanent. The AI server becomes a commodity like a laptop. Everyone makes them, and nobody makes a profit on them. SMCI is forced to